to everyone, to all our audience, and today to our guest, John Reade. Very good to see you. How are you doing, John?
Very well, thanks you, Antonio. It's a pleasure to be with you today.
Thank you, the same. So, John, with you today for our 20 minutes coffee, we're going to talk about commodity. We're going to talk about specifically with gold with you. So, John, it's the first time that we have this inaugural talking together. And John is a senior market strategist at the World Gold Council. You are there from quite a few years now. I think it's 2017, right?
Yeah, I started at the beginning of 2017, but it's even longer than that. I mean, I've had a 40-year career in gold now. Started off as a mining engineer working in the gold mines in South Africa. I've been a gold equity analyst covering listed South African gold companies. I worked at UBS for a long time in commodity strategy, eventually running commodity strategy there. I worked at a hedge fund for 7 years as a partner at Paulson & Company. And I've now been at the World Gold Council more than 8 years. So it seems as if I've been talking about gold for a very long time.
Good. This is what we like. We like to talk with experts. And that's the reason why I'm very glad that you share this important time with us. So, John, a lot is happening in the market. I would like to kick off with you. The macro environment that we are experiencing, it's very tricky. Still, the inflation is not very much under control. Actually, looks like that the policies put in place from the US government are inflationary, that disinflationary, no? There is consensus on that. I would like, of course, to hear your point of view. And then also another risk that we have on the table is the geopolitical side. So a lot, right, happening in the market. But you just released a very interesting research paper, no, on gold. That is your expertise. And my question is, considering all this background that we saw, we know about, why we have to continue to consider as a relevant asset class gold, put this one in the portfolios?
Sure. I mean, the argument about having gold in portfolios all the time is very straightforward. Over the long term, it's produced returns that have been in line with or better than other asset classes. And that's whether you look from 1971, when we came off the gold standard, over the last 20 years, over the last 10 years, or even over the last year or two, it's produced good returns. But those returns are only a small component of it. Probably the biggest advantage that gold has in a portfolio is the diversification benefits that it brings. And that's because gold is generally uncorrelated to equities or assets with equity-like risk-return characteristics. So that's useful. But what's particularly good is when equities sell off rapidly, falling by, say, 2 standard deviations in a week, gold's correlation flips negative. And out of all the asset classes out there, gold's the only one that really demonstrates this. So bonds tend to, during risk events, positively correlate with equities. So you don't get the same protection in the portfolio that you might think from having government bonds as a diversifier. So having gold in a portfolio is diversification that works particularly well when you need it the most. So that's really good. It's a source of liquidity. So a market which is normally about $150 to $200 billion a day, this year more like $300 billion a day. So that means if you do need liquidity for your portfolios, you can access it. And that liquidity stands up really well during stress periods as well. And then finally, you add all those things together, you look at the impact, not of gold itself, but what gold does to your overall portfolio, and it's particularly good. Adding the right amount of gold to a portfolio increases the risk-adjusted return of that portfolio pretty much wherever you look. We've done this exercise in the US, in the UK, various countries in Europe, Singapore, Australia, India. Doesn't really matter where you look. having the right amount of gold increases the risk-adjusted return of your portfolio by contributing some to returns, but mostly by lowering portfolio volatility because of the diversification benefits. So that's the time-honored reason why gold should be in your portfolio. Now, why should you be looking at it particularly closely now? I think you raised a lot of the issues in your introduction about things that are concerning market observers, things that may lead to weak performance of other asset markets. And gold tends to do well, for example, during periods of US recession. It tends to perform well during periods of stagflation. Both of those potential outcomes from what's happening in the US at the moment. My particular concern is when I look at across asset markets is equity markets seem to be shrugging off any of the risks associated with both the tariffs, but other issues that have been raised by the new US administration, and what the consequences could that be for both the domestic economy, but also the international economy. And we look to be in a situation where there are clear risks to growth across the world as a consequence of these statements and policies. And I just don't think that's being factored into equity markets at the moment. So gold has demonstrated very aptly that when equity markets have weakened dramatically, like, for example, after Liberation Day, then gold has performed well. It's also performed well in environments where so-called other safe haven assets, like the US dollar, like US treasuries, have performed poorly as well. So that tells me that its diversification benefits, its portfolio benefits have been reinforced this year, and that some of the other safe havens that you'd normally turn to just aren't playing that role. And to me, that's the global financial markets taking a big look at what's coming out of the United States and saying they really don't like it at all.
Very interesting. You mentioned a few very interesting things. The uncorrelation side. Then you mentioned also in one of your point that it's important for each investor to add a percentage of the asset class of their asset investments in their portfolio. Considering your experience, when we talk, of course, for us with investors are multi-asset players. So this percentage, in your opinion, it's part of what? It's part of the alternative side of investments. It's part of the riskier side. If you can give a little bit based on your experience, what is your thinking?
Now, I would argue that it should be part of the hedging component of your portfolio, which offsets the risky side. So, if you know, and let's just play hypotheticals here, and you think about a 60-40 portfolio, which we were taught years ago is the way you're supposed to invest. So the 60% in equities is fine. Leave that alone. The 40% that you have in bonds or other protective assets, that's where gold, in my opinion, in our opinion, fits most naturally, because of its diversification properties against equities. Not all investors look at it that way, though. I mean, 60-40 is a massive simplification. We come across investors, pension funds, asset managers that will have lots of different buckets within their portfolio, some of which will be inflation protection. So I know some very large investors that use gold as an element of their inflation protection bucket within their portfolio. It's not a magic trick that all of your inflation protection comes from gold, but it certainly is a very useful component to an inflation protection strategy. Others might have it in an alternatives bucket. Some investors, perhaps less common now than maybe a decade ago, might have a commodity allocation within their alternatives bucket. But investing in commodity index products, very much the vogue, as I say, in the noughties with the so-called super cycle, those have fallen a bit out of favor because of returns and particularly because of cost of carry, etc. But still, some investors do have those. We'd argue that if investors are looking to have commodities within their portfolio, then gold is actually the best commodity. Simply because of its combination of return and diversification benefits. But crucially, doesn't have any carry cost associated with it, or a negligible carry cost associated with it. You have no roll yield when you're owning gold within a commodity portfolio, unlike, say, crude oil or nat gas futures or wheat or whatever. So I'd say there's lots of different places that people use gold in a portfolio, but I think it should be now considered a fundamental part of the hedging element of your portfolio that hedges your equity and equity-like risk. And that's particularly valid in an environment where bonds probably aren't going to give you the same degree of protection going forward as they have done during the 40-year bond market, bull market in bonds between 1980 and 2021.
Now, John, I would like to ask you, you mentioned a few important institutional investors that buy the asset class, but one that take a lot of attention are the central banks, no? And actually, in the last months, probably even more, quarter, let's say, they've been adding a lot of gold in all their forms into their portfolio, their asset under management, right? Do you think that this one is a way also to create a speculation in the pricing of the market, or they are actually trying to diversify from buying US treasuries?
Well, I think there's a number of reasons why central banks are adding gold to their portfolios. Most of it comes down to the diversification argument. If you look back since the global financial crisis, central banks have bought gold every year since 2010. And they were buying good amounts of gold, roughly 10% of the market each year between 2010 and 2021. The big news in gold, though, was the fact that in 2022, they doubled the amount of purchases. So we saw 1,000 tons of purchases, more than 20% of the gold market in each of 2022, 2023, and 2024. That strong buying continues. Now, I don't think it's for speculative purposes. Central banks, in my opinion, don't speculate a lot. And if they do, they generally use accounts which they don't have to report to the IMF in terms of their monetary holdings of both currencies and gold. So I don't think that the purchases that we're seeing are really turning up as speculative transactions. Rather, I think what is happening is a number of factors have triggered their increased interest in gold. The first of which is inflation. If you think about the challenge that central banks faced in the 10 years before COVID, it was getting inflation up to target. Now, with a burst of inflation that we saw coming through after COVID, I think most people would recognize that the challenge that central banks are going to have in the medium term is sticky and too high inflation. So a very different challenge to what you've had before. If you have a different view on inflation, you probably have a different view about gold allocation. I think de-dollarization, a trend of central banks owning less US dollars, it's been in play for a decade or more, that continues. But it's probably been accelerated by concerns about US debts and deficits, which really are large and worrying at the moment. And then the final point, of course, is the sanctions resistance of gold. Gold, whilst it has many of the characteristics of a financial asset, and you can trade it on a screen and in many different ways, but you can also own it physically under your own control. And having gold physically in your own country, under your own control, gives you an asset that is nobody else's liability, but more to the point as well, it can't be taken away from you by sanctions. And that pretty much is the situation that happened with the Central Bank of Russia following the invasion of Ukraine. So I think those three reasons are the main ones for the increase in central bank purchases that are taking place.
Indeed, I appreciate it. I think we have to consider, actually, we used to consider as a real asset class, but actually we can put it in the hard asset when we talk about the physical side. And this is also what is very relevant. Now, in our top-down way, as usual, John, I would like to ask you a little bit much more on the performance side of the asset class. Can you walk through us a little bit about the last 5 years And what do you think are the expectations going forward? This is the main question, but also I would like to attach to this one. What are the main drivers of it?
Sure. I mean, the way I think about gold is, and the way we think investors should think about gold, is that over the long term, it's an asset that should deliver something around US inflation plus 2 to 3%. And we've published quite a lot of work on this, like a fundamental framework of explaining why gold has delivered real returns since 1971, what are the drivers of those real returns being, and what they will be going forward. We've also done this in conjunction with academics as well, because to be frank, if the World Gold Council tells you something about gold, you should, or you might, be a little bit skeptical. So I think it's important that we've got this academic material as well. So if we think that inflation in the US is, well, let's pretend it's 2% like it used to be, you should be expecting nominal returns in gold when you're putting them into your asset allocation models of around 5%, maybe, around 5%. So what have we had in the last few years? We've had much more than that. 2023, 19% returns in gold. 2024, 26% returns in gold. And at the time of recording this podcast, we're up about 22, 23% year to date, all of these in US dollar terms. So that tells you a couple of things. And it links back to the question you asked at the beginning. First of all, it shows you that we're in relatively extraordinary times. Okay? Things are different and have been different over the last few years. And I think I've explained some of those in the actions of central banks. I think the other thing is as well is that risk and uncertainty that has come out principally out of the United States, maybe also with a geopolitical element to it as well, has been driving investors towards gold. And if I look at who has been buying gold actively over the last 3 years that have generated these strong performances, it's not really Western investors. I've mentioned central banks, they've been a major component of it, but it's also emerging market investors too. So emerging market demand for gold has been, the largest component of gold for a few decades, but most of the price action has been made in London and New York by Western investors and speculators. That's changed over the last few years. Western investors buying less gold, particularly in the United States and in German-speaking Europe, whereas emerging market investors buying much more. So their influence on the market has become really profound. Now, that's an interesting set of circumstances as far as I'm concerned, because it means that there are a large component of potential buyers in gold that have remained more or less sidelined for the last couple of years. And here we're talking about US investors, retail investors, institutional to a degree, and similarly in Europe as well. Now, typically in the US, these investors come to the market when the equity when US equities start to perform and enter a bear market, when we're entering into a recession in the US. So there is all that uncapped potential, I think, for additional buying to come to the fore. In the case of emerging markets, they're buying gold for mainly domestic economic and political reasons, and that can continue, I think, for years to come. So despite the very strong performance that we've seen in gold in the last few years, with this backdrop of very high risk and uncertainty, probably a slowing economy, and to be frank, I don't know what's going to come out of the US in the next few years, but I can guarantee you that we're going to have a few surprises along the way. I think having gold in your portfolio at the moment makes more sense than ever.
Indeed, we will see what's going to happen, definitely. But we're going to be here once again to talk. I'm very happy to have had this chat with you, to be updated from you. I really appreciate it. It was very insightful, delightful to talk with you. And sincerely, I'm looking forward to the next one already, to be updated even more.
Well, thank you very much, Antonio. It's a pleasure to talk to you and your investors.